Now, this is one of the companies I actually get asked about the most often. In fact, I recently just initiated a position in it. However, I may be hesitant to build it out, even though I think that there's a high chance that the company can do well. HIMS and HERS is a company that took a nosedive recently, falling over 40%. And in this video, we explore the risks that are involved, whether or not the sell-off is warranted, and whether or not there are actually some legitimate concerns to be had about this company. We also explore one piece of information that the company used to disclose that they are no longer disclosing anymore, and that makes me feel a little bit uncomfortable. And despite all of that, why I still think the company has the potential to do well. But as always, potential is a dangerous word, so let's dive in. Now, I have to say, for a large majority of my investments, I find myself investing in tech and financials because these are markets that I understand the most easily and can understand the value proposition of the companies in these markets. So when I started this position in HIMS and HERS, it's basically to allow myself to expand my circle of competence and to understand different sectors of the economy. See, I've long stayed away from telemedicine, telehealth companies because you have to understand from my context, right? Living in Singapore, if I ever wanted to see a doctor for medicine, I just have to take a 5 to 10 minute walk down my house into the nearest clinic. I can see the doctor on the same day and get the medicine at the same time. So I've never had a need for telehealth and telemedicine services, and because of that, I never saw the value proposition until I studied this company. So apart from this telehealth and telemedicine, they're also involved in drug manufacturing, which is another industry which I tend to stay away from because of my concerns about regulation and some of the complications that arise from drug manufacturing. But with that said, right, I think sometimes as a layperson, we have an advantage in the way that we look at the business. Basically, we see it from a lens of a consumer rather than just numbers. So from a consumer's perspective, when I look at HIMS and HERS, basically I have 3 questions. The first one being, why will people want to use your products over a FDA-approved product? Second question I have is, why do compounded drugs? Why don't you just sell normal drugs? And the third question I have is basically whether or not is this a safe option? Is there any hidden side effects that, we don't really know about? So HIMS and HERS basically has a pretty straightforward business model. If you understand how they work, right, they are a direct-to-consumer healthcare provider. Now, all their products and services, right, is basically available for purchasing on their website or through mobile apps. Now, in the past, they started out treating chronic conditions and some special conditions, which I'm going to show over here. Over time, they actually gradually expanded their offerings. Now, one of the things I've come to realize when I was studying this company, right, is that their target market is not the group of people who actually see the doctor for things like the common cold and flu and all that. Because when I was thinking about telehealth medicine, that was the context within which I was thinking about it. And because of that, I didn't see the value proposition. However, their focus is basically, on people who needs prescription medication, people that require these medication on a recurring basis, and regular care from healthcare professionals. Now, of course, at the same time, they also offer over-the-counter services. Now, as part of their service, right, HIMS and HERS basically provide telehealth consultations. These doctors are partner institutions. They are not in-house doctors. And what you do is after you see these doctors, they give you your prescription and things like that. You take your prescription to the HIMS app, and you can actually buy the medication directly from HIMS. Now, naturally, as a layperson trying to understand this company, when it comes to medication, like I've mentioned before, the biggest concern for me is the safety of whatever you put into your body, right? So I was worried about the medical standards and things like that. So HIMS actually have their own internal quality control, which actually, honestly, for me, I don't really care. Because internal QC, can always be biased, right? But when they white label other drugs, this is the interesting thing. The manufacturer of these drugs are actually required to comply with FDA regulation and CGMP, current good manufacturing processes, which is also enforced by FDA, which makes me feel a lot safer. So everything is good here, right? Apart from this, another aspect of their business, right, is their subscription business. And to me, as someone that invests in tech and financials, this is their most exciting part of their business to me, right? Firstly, it provides a recurring source of revenue that is very predictable. And because they target customers with recurring medical conditions, with recurring medical needs, this subscription actually makes sense because they don't have to keep going to the pharmacies to get their medication. They can just subscribe to the service. They can actually key in all their details, and then the medication will get sent to them on a regular basis. So to a large degree, I think it makes the company revenue a bit more robust, more predictable, as customers here are basically built with a regular cadence, and then it's easier for us as investors to track. So at the same time, as with every subscription service, I think the most important metric is not how many new subscribers you get. Okay, the most important thing is how many subscribers you keep, and we'll talk about that a little bit later. HIMS and HERS actually believe that they have a vertically integrated platform. On the service side, definitely for sure, from diagnosis to prescription to purchase, fulfillment, delivery, and all of those clinical management, all the back-end stuff, all can be done through their tech platform, which is basically their app. Now, this allows them to definitely bring down the cost over time and pass on some of these cost savings to the customers. And I think that's definitely true. It can be seen in their gross margins. Right now, their gross margins are over 80% range for the last couple of quarters. In the past, they have actually guided for their gross margins to be in the 70% kind of range, but now they are definitely overperforming in that respect. Now, and as a skeptic skeptic initially, right? I was wondering why in the world would someone use a HIMS and HERS product over just getting an FDA-approved drug off the shelf and things like that, right? So that's when I actually came across this article. Now I'm going to read it out for you. You see what it says. It says a drug may be compounded for a patient who cannot be treated with an FDA-approved medication, such as a patient who has an allergy to certain dye and needs a medication to be made without it, or an elderly patient or a child who cannot swallow a tablet or capsule and needs medicine in a liquid dosage form. So basically, when I realized that compounding drugs, right, it's not that you're making a whole new drug. It's basically the same drug in different forms, or missing out certain non-essential components of the drug that can cause an allergy. So that's not too bad. Now, the third thing I want to mention over here, basically is something that you need to pay attention to, because I'm going to bring it up later on when we talk about the risk involved in investing in these companies. Now, the last part of this article, it says compounders also may prepare compounded versions of drugs on the FDA drug shortage list if the compounded drug meets certain conditions detailed in federal law. So this is very important for us to understand the risk of the company later. Now, so for me, right, basically I realized the biggest bull case for HIMS in this regard is not the individual medication that they offer to people, but in personalized subscription. Now, when we take a deeper dive into the subscription numbers, their whole subscription business is growing. But what I like is this chart over here that shows the growth of personalized subscription, where people are actually ordering medication, where the dosage and the delivery method can be tailored to suit them. So, imagine if this medicine is usually off the shelf. If I buy it off the shelf in a pill form, I can actually get it in a liquid form or things like that is easier for me to consume. So this means, right, when you order these medications, the dosage can be adjusted to suit you, to mitigate against allergies and side effects and things like that. You can even add in minerals and vitamins support instead of just having to take a whole bunch of pills. Everything can be actually compounded and put into one pill, which I've seen my grandparents do in the past, right? They tend to have a bunch of pills all lined up, and then some of the pills they actually have to break it up into half tablets and things like that and put it into this box with the labels Monday to Sunday. So if people actually get into their system and start buying drugs that is personalized to them, then I think this makes their subscription very sticky. Now, this is not like headache and the common cold where I was thinking about earlier, where I'll just get whatever off the shelf medication and be done with it. So the conditions that they are helping people with are often long drawn, and if I'm going to take medication for an extended period of time, then of course I prefer it to be personalized to me lah. So as we can see, right, there is demand for it, and what I like to see is really the stickiness of the business. Now, I would presume that this is definitely a sticky business, just from my point of view. However, I think management can be a little bit opaque on that, and I will raise that up later on when we look at the financials lah. But for now, this is just to understand their business and their value proposition, right? So basically, they actually sum it up for me over here. Their biggest moat is their personalized subscription, and they personalize your medication in 3 ways, either through the dosage, through the mode of delivery, and by combining multiple conditions. Naturally, I don't know about you, but when I think about it, the first thing I think about is where got so gamma is there so many people for you to treat that has more than one conditions. Now, for international audience, the word I just used, gum, right, just means, how can it be such a coincidence, right? But rather than use so many words, we simplify it to gum. Where got so gum that everyone has more than one conditions, right? It's very unlikely. However, on further reading, I actually realized that, the areas that HIMS actually target and they actually started out to build their verticals in was actually quite strategic, because I realized for people who are suffering from some of these conditions like hair loss, obesity, ED, and things like that, right? These conditions are usually not the main conditions. They are symptomatic of a more serious condition, or basically indicators of a higher risk of certain conditions happening. So as you can read over here, it says, for example, through HIMS and HERS platform, providers can prescribe a personalized treatment that combines a doctor-trusted erectile dysfunction treatment with a statin which can help protect at-risk men with erectile dysfunction from serious cardiovascular events like heart attacks and strokes. So the medication, right, that people actually get from HIMS can give you the exact dosage a person needs to deal with both issues at the same time. And when I realized this, then, really the light bulb went off. See, now I see the value proposition. I see how this, becomes a big total addressable market and how this can potentially disrupt parts of big pharma. So this makes their product sticky. There's definitely switching costs now, because if I actually find a personalized healthcare subscription that works for me, then it's going to take a lot for me to want to actually switch all my data, all my current personalization over to someone else. And so another aspect of their business, right, is basically ensuring the safety of their product so that they will not get into trouble. And so for that, I actually dug into the FDA website to see what they say about compounding drugs and how safe they are. So basically, the FDA tells us about the process to ensure stringent regulation and processes that are basically put in place. So basically, there must be a state licensed pharmacy or federal facility, and the FDA actually conducts regular checks on them. So all that to say, it's not like what I thought, previously. It's the Wild West, and regulations are quite lax. There's a lot of loopholes and things like that. So seeing this on the FDA website actually gives me a sense of, at least everything is okay. Everything, the rules and regulations are in place. There's a proper framework to ensure the safety of the processes there. So I think for people who want to argue that, no matter what, compounded drugs are still not as safe as FDA-approved drugs, I think that is a very different and more nuanced discussion. I think the value proposition here is that because the FDA-approved drugs are already either in shortage or not viable for the patient, that you have to take this alternative, and this alternative is actually still safe. And so if you think about the whole basis of this company and how they make their money, their main revenue driver in the years ahead definitely will be their subscription business, and it's not any individual product line or new medication, because this is not a company that's going to come up with some revolutionary medicine and things like that, right? So they actually grow their business by growing their customers. They actually can increase their marketing spend to definitely grow their customers, which is one of the things they have actually been accused of previously, right? They have a very strong marketing arm, but people actually just label them as a marketing company. So basically, people are saying without the marketing, they will not be growing as fast. So that is something that we'll be looking at. Second thing, another way for them to grow their company is to expand their treatment of new condition. Now, this page says it all, right? The different conditions that they are currently treating, the different new verticals with a broad category that they are yet to expand into. So they can not only add on new verticals, which is like sexual health, dermatology, mental health, weight loss, then they may have a new category. But within these categories, there are so many different conditions that they can go after. So they have a pretty large TAM. And then finally, expansion of geographies, which is basically management talk about, in future, they are definitely looking at international expansion. And so that brings us to the conversation about the total addressable market, right? The global telehealth market was valued at 142 billion back in 2023. Now, this was projected to grow at a CAGR of 22% all the way through to 2032, so reaching a total market value of 790 billion. Of this 790 billion, US would make up about 254 billion. So about a third of the whole market will be in the US. So from that, we can actually see that HIMS and Hers has a very big total addressable market. Now, on top of that, you also have to consider the global compounding pharmacy market size. This was valued at about 16 billion back in 2023 and projected to hit about 28 billion by 2032. However, when I started to think a little bit more deeply, right, now these two markets don't fully represent the whole business model of HIMS and Hers. You see, they're not a generalized telehealth medicine, neither are they a compounded drug company. The actual TAM basically is, people falling sick. So to assess their TAM, I think it goes beyond looking at the general numbers for each industry, but into each vertical that they are addressing. So let's take the weight loss market. The weight loss market in 2023 is a $280 billion market, which will grow to $530 billion by 2032. And that's just one vertical. So I'm going to bring back the graphic that I talked about earlier. Imagine the different verticals of mental health, sexual wellness, dermatology, and the new verticals that they haven't even expanded into yet. So their total addressable market here is huge. Now, having a very big total addressable market is good, but it's only good if you are able to capture the market and retain your market share. This is why we need to explore the moats of the company and the risks that are involved in investing in such a company. Now, if you understand this company, right, you basically realize that the biggest short to medium term risk facing HIMS and Hers is their venture into the GLP-1 compounded product space. This is probably one of the reasons why their stock actually fell over 40% in the last couple of months. So let's dive a little bit deeper. Now, I'm going to try and simplify this as much as possible, so bear with me here, because I'm going to name drop some medicine names and things like that. But don't worry about it. You don't actually have to follow and remember all the names of the different compounds and medicines. I will tie everything all together right at the end so that you can understand the main risk facing the company without having to remember all these names. Now, I have to preface by saying I'm coming at this from the angle of a consumer and of someone that basically used to invest in tech and financials. So I'm applying some of the same principles over here. So if I'm wrong or mistaken, please do let me know in the comments, and I love to basically have a dialogue conversation to understand this space a little bit better. However, if you think this is helpful, I would definitely love it if you smash the like and subscribe button right now, because your response on the previous SoFi video was absolutely amazing. So I hope this will be helpful as well. And back to the video. I think it's important for us to remember, right, that the moat of HIMS and Hers is in their personalized subscription business and not in individual medication. So why am I saying this, right? Because from what I understand, when it comes to drug manufacturing, the patents are important. And when the patents are active, that is when the drug manufacturers make the most of their profit. And after that, once the patent expires, it's basically a race to the bottom in terms of price. So how does this affect HIMS? Right, if you remember earlier, we said that companies are allowed to make compounded versions of drugs when these drugs or these ingredients are on the FDA short list, right? Or shortage list, sorry. Well, there is a SEMA semaglutide shortage, which is the main ingredients in these two drugs called Ozempic and Wegovy, right? So these are actually produced by a bigger company called Novo Nordisk. Some of you may have heard about them. And GLP-1 was primarily used to actually manage type 2 diabetes. But because this ingredient, right, this semaglutide is an appetite-suppressing ingredient, people actually use this to fight weight loss as well. So because of this actually caused a worldwide shortage because this medication previously was only produced to help people with type 2 diabetes, but now people are also using it to fight weight loss. So there's a very large demand for this drug suddenly. So in this study published in Medical News Today, they found that when they look at all the new GLP-1 medication users, right, there was a twofold increase in the number of people who do not have type 2 diabetes and are using this purely for fighting against weight loss. You see, basically the problem is that this drug is actually patented and HIMS were unable to compound these GLP-1 type drugs. However, because of the shortage, now the FDA basically allows them to compound these drugs, and because of that, they actually took the opportunity to build out their facility to produce this drug. And the worry that people have, right, is that because HIMS already invested in all this infrastructure to compound this drug, what if this drug is one day removed from the shortage list and then protected by the patent again? Does that mean that all their investment is for nothing and they are unable to sell all these drugs anymore? And so because of this uncertainty, people start to worry and start to sell off the stock. And if you thought that was all, that is not all actually. Eli Lilly, another competitor, cut their prices of their compounded weight loss solution by half, which actually caused the worry that will basically spread out the demand, right? It will pull demand away from HIMS. But you got to understand the reason why Eli Lilly actually cut their prices, right? Is because their solution actually has two components: the vial, which contains the medication, and the injector pen. Basically, right, what happens is that they have a shortage of the injector pen right now, which is why they're cutting the price in half just to sell the vial. And I think because sometimes as institutional investors, they look at this and say, wow, price is half, people will start buying. But that's why I say sometimes as a consumer, we have an advantage. At least to me, I think that this is an advantage. Because if I were to put my consumer hat on and I were to compare the two different solutions by the companies, right? HIMS weight loss offering is basically between $79 to $199 per month, fully personalized to you, which means there is no problems in terms of the delivery and stuff like that. Now, although Eli Lilly's price actually dropped by half, their monthly cost is still about $399 to $549 per month. And then you have to find your own injector pen on top of that, which is an added inconvenience. So on the surface, yes, Eli Lilly did cut their price in half and it sounds scary, but as a consumer, personally, I would think that I would rather stick with HIMS, right? Because their cheapest offering, Eli Lilly's cheapest offering, is still twice the price of HIMS' most expensive offering. In addition to all of that, HIMS is basically tailored to me. The delivery method and everything is all personalized to what I'm currently using. Whereas if I were to switch to Eli Lilly, I would basically have to find my own injector pen, which is an added inconvenience. So to me, the real risk is not really in this whole Eli Lilly cutting their price, but it's in the patent coming back into effect to protect the GLP-1 products. And so you see, this is where the problem actually comes in. You have articles saying that this shortage will be prolonged. Yet in other instances, CEO of big companies like Eli Lilly actually say that the shortages are coming to an end. So if HIMS continue to sell these compounded GLP-1 products, there could be legal ramifications. However, HIMS management in the latest earnings call seem to think that their data shows that the shortage will last longer than expected. So it remains to see how this plays out. So in summary, right, people actually sold off this stock because HIMS made a big investment into their infrastructure to produce this drug that people use for weight loss. However, they potentially have to stop selling this drug in the near future. This is because this drug may no longer be on the FDA shortage list after a while, and then the patent protection basically comes into effect again, which means their whole investment goes to waste. By right, that should be the end of the story, but I'm not satisfied and I dug a little bit deeper. You see, from my time studying engineering, I have to say that, I might not have paid attention too much, but I actually remembered that you can actually check some of these patents online. So I tried my luck, I Googled, right? And what we're looking at here is the patent for the semaglutide and the brand names that we actually talked about earlier, Ozempic and Wegovy, you can see over here. Now, when I looked a little bit deeper, there are all these different categories and I tried to understand what they mean, right? So when you look at the data over here, you can see the data protection expiry date is on January 4th, 2026. So from what I understand, again, please correct me if I'm wrong, but it seems like when the data protection ends, right, companies can actually start manufacturing these drugs and sending their drugs for approval. But for the FDA, they just cannot start to sell their product yet. And they can only sell it once the patent ends, which if I look over here, it seems to be in March of 2026. So of course, could they extend this patent? Seems like it's possible, but I'm not sure they will do so or whether they can even be approved to do so. So what are the regulations around that? I'm not exactly clear right now. So if someone is a patents expert, please do let me know. But it seems to me like by 2026 in March, right, this patent will expire. So what do I take away from all of this? Well, if I were to think about it, basically I see this as a matter of perspective. I believe, from the way that they have presented their data previously, this GLP-1 drug was already in their pipeline. And they would probably thought that, this is something that in 2026 we want to get into once the patent expires and things like that. However, HIMS probably saw this shortage as a chance to build out this arm of their business, to build out this vertical before the expiry of the patent. You see, I think they found a loophole where they can actually build out their offering, start selling it to gauge the demand before the patent expire. And then once the patent expires, they're basically good to go. So to me, how I see this is that basically the risk is that they can probably continue selling their GLP-1 compounded products until maybe mid-2025. And then they probably have to put a stop to it for 2 to 3 quarters. But once the patent expires, they won't have to spend time and additional resources to build out the business, and they can start offering this again, after March of 2026. And remember their value proposition, right? It's not in individual medication, right? So even this have to be taken off the shelf for a couple of quarters. That doesn't really affect their business as a whole, because their business is in personalized healthcare solutions. So this is just one part of the whole machine. However, because of this uncertainty, definitely, this is only going to be a tiny position in my portfolio, because even without the GLP-1, the company's financials are actually still strong, right? Short-term headwind, yes, but I think the long-term thesis is still intact. So that's why I don't mind starting a position. However, it's going to be a very tiny position until a lot of this uncertainty starts to clear up. Now, I believe marketing is another aspect of this company, right? It can be both a moat and a risk at the same time. I believe it's a moat because they really have very good marketing. You see, skeptics actually call them a marketing company. And honestly, before I dived into the company, I kind of bought into that narrative because they were so pretty on the outside, right? But they really have a very good business behind their marketing. But that's not to say that there are no risk involved. I think the risk to me is basically how marketing is correlated to customer growth. So basically, if I decrease marketing, will I still generate similar member growth? And another thing I want to take a look at is their payback period, right? They actually disclose this in their earnings. Will the payback period continue to be less than a year, and will it continue to trend down to maybe a couple of months? This is something that I'm tracking, and I want it to continue to trend down as they maintain customer growth and as I see customer growth continue to go up. Additionally, I also want to see the stickiness of the member, because when it comes to subscription services, right, I don't want a business to grow because the people coming in far outweigh the people that are leaving. That is unsustainable. I want the business to grow because people are staying, so that there's less pressure to actually pump out marketing just to generate new members to make up for the fact that you're actually losing customers. So this is something that we will take a deeper dive on later. I'll explain it when we look at the financials. And of course, like I said, HIMS is basically a vertically integrated company. So you basically key in your data into their own platform. On their website, you can basically key in your own personal information and things like that. They will then link you up with a doctor. You do your consult. Your info is already stored there. Now, I don't know how the healthcare system in the US works, but I have a family doctor, right, that I like to go to because he has my medical history. So when I go, he already knows my allergies and things like that. He has all my data with him, so I feel comfortable going back with him. And then when he makes recommendations, when he makes prescriptions, right, it's with all these things in mind. So I believe HIMS is offering the same proposition through their tech platform. See, with all this information, right, not only are they able to give you a better diagnosis, not are they able to take note of all the allergies that you have when they make a prescription. Additionally, I think all this actually gives them data onto the new verticals and business to grow, because having all their customers' data, they actually know which is some of the conditions that is more urgent for them to start building out verticals into, and for them to be able to cross-sell customers on other products and new offerings. And now we basically come to the juiciest part of this analysis, which is the financial statements, right, to see whether or not this is a fundamentally sound investment. Now, if you take a look at the revenue for HIMS in this past quarter, in Q2 2024, revenue came in at 315.6 million, a 52% year-over-year growth. Net income came in at 13.3 million. Now, adjusted EBITDA also came in high at 39.3 million, which is a 270% year-over-year growth. So these numbers actually look quite good, but we need to factor in the impact on the GLP-1 drug. So let's take a look at what management says. Now, management actually told us in the Q2 earnings call, right, that this GLP-1 basically made up for about 16 million in revenue this quarter. So you take it out, you get a company growing at about 46% year-over-year instead of 52%. So the question facing investors is whether or not this potential drop-off in revenue really justified the 40% drop in stock price. So everyone needs to come to their own conclusion. But for me, I think it might be a little bit of an overreaction, because that's not to say, of course, that the risks are not real. I think the risks are real. However, one thing to note, right, in the past, they actually said that, the gross margins will be in this 70% range to pass on cost savings to customers. However, whether or not this should still be the expectations, or whether or not 80% is the new 70%, is something that we have to pay attention to, because in the recent earnings, management actually told analysts that their gross margins will continue to go back up as long as they scale this GLP-1 product. So this is something that will impact us when we do our long-term projections for this company. Okay, so now we have come to the part of the financial statement that actually makes me a little bit uncomfortable over here. Remember I said there was a piece of information, right, that the company has stopped disclosing, and that made me uncomfortable, and so this is it lah. If you look at the subscribers this quarter, it shows 43% year-over-year growth, monthly average revenue per subscriber in the mid-50s, which is steady. So these two numbers are good. But they used to show this slide over here. And so if you take a look at this chart actually draws a parallel or draws a relationship between the existing subscribers and the revenue that they generate, along with the new subscribers and the revenue they generate. So if you zoom in to just 2020 and 2021, you can see that in those 2 years, right, the subscribers doubled. And so did their revenue, of which half was attributed to repeat customers and half was to new customers. So you can see the revenue generated by repeated customers was growing at an 81% CAGR during this period of time. So that is healthy. But now they don't show this anymore. So that is something that definitely concerns me. They just show their total subscribers and average monthly spend. Okay, so why is this concerning to me? Because if from someone that is coming from a tech background, financial background, when it comes to investing, right? When it comes to subscribers, I'm not just interested in subscriber growth. I'm interested in sustainable subscriber growth. Now, I want subscribers who are using the platform actively and are spending more on the platform after each and every single year. I do not want, the case where the subscriber number is growing because you are marketing so heavily such that the new input basically offsets whoever that is churned off your platform. Some people may say that this is a bit of an over-exaggeration, I'm thinking too much and things like that, but let me put this into context for you. You imagine there are two businesses out there, right? They both offer a subscription program. Business A, Business B both have 10 customers to start with. Now, Business A has 10 subscribers. They lose 5 subscribers, so that means they have about 5 subscribers remaining, right? So let's say they each spend about $1,000 on marketing. This marketing spend will basically get them 10 subscribers. So for Business A, I had 10 subscribers, I lose 5, and then I spend $1,000 on marketing to gain 10 subscribers. I end the year with 15 subscribers. So you report, hey guys, we actually got 50% subscriber growth. Now imagine Business B. They got 10 subscribers. They only lose 1 subscriber, which means they have 9 subscribers remaining. Now, firstly, if you spend $1,000 on marketing, right, assuming the same efficiency, you end up the year with 19 subscribers, 90% subscriber growth. So that is the most obvious effect of retaining subscribers. But that is not only what I'm looking at. Consider another issue. Remember in my previous SoFi video, I actually talked about this thing called CAC, customer acquisition cost. If you don't remember, or you want to know why I like SoFi more than HIMS, you can take a look at this video, which I'm going to link over here. But basically, if CAC is $100 and I want to have 50% subscriber growth, then I only need to spend $600 on marketing for company B. Now, where does that other extra $400 go? Right down to the bottom line. That is why companies that actually deal with subscribers need to present to me their subscriber retention for me to feel a little bit more comfortable in the investment. I just want to quickly jump in over here because after I recorded, I realized that I didn't really do a quick comparison. If you just take a look at the 3 scenarios, in the first scenario, Business A basically spent $1,000 on marketing to grow subscribers by 50%. Now, why I like Business B better and why I'm so particular about marketing is because if you look at the 2 scenarios, Business B has the option to spend $1,000 on marketing to get 90% growth. Or if they only want to target 50% growth, they can spend $600 on marketing with an extra $400 in profit. So in this case, the 2 scenarios of Business B is much more scalable of a business compared to Business A. Now, this is not a thesis breaker for me for sure, because I know, in this earnings call, a lot of companies actually just want to present their best side to you. But for me, I guess personally, I'm saying that this is something that I will consider when I portfolio size my investment. Now, one bright spot for them definitely, right, is their marketing spend as a percentage of revenue has been going down over the last couple of years. So if you take a look over here, marketing spend fell from 51% of revenue to 46% of revenue, while everything else more or less remained consistent. Now, definitely, I want to see this marketing spend as a percentage of revenue fall even further to the low 40% or even better, high 30% kind of range. Then if I take a look at their balance sheet, they have 129 million of cash and equivalents. So basically, their total assets is 290 million. They only have about 29 million in debt. And if you take a look at their current liabilities, it's about 108 million. What this means is that just using their cash and equivalents, they can wipe off all their current liabilities, which puts them in a very, very safe position. If you take a look at the cash flow of this company, operating cash flow of 53.6 million, up 219% year over year, free cash flow of 47.6 million, up 377% year over year. Now, I know all these growth numbers look very big, but because the numbers are small, so you can get all these very big numbers. So basically, as the company grows, I expect some of these numbers to normalize and come down a little bit. Now, another concerns that a lot of investors have is this thing called stock-based compensation, right, or SBC. So from a year ago, that was about 81% of revenue. However, that dropped to 6.8% over the last few quarters. However, in this latest quarter, Q2 2024, it popped back up to about 7.6%. So I think it's important for shareholders to see the downtrend continue. So this uptick in stock-based compensation may be due to their build-up of the GLP-1 venture, and then they have to hire people and things like that. So I can understand why this actually popped up in this most recent quarter. However, I don't like the fact that they're actually diluting shareholders when they do this stuff. So the only thing I can say is at least they're buying back shares, right? So they have actually repurchased about 50 million worth of stock in this last year, and they approved another 100 million in terms of their buyback program for the next 3 years. To take a look at their full year projections, right, basically by the end of the year, they expect to generate between 1.37 to 1.4 billion in revenue for the year 2024, which represents a 57 to 61% growth. This is up from the 1.2 billion reported a while ago. Long-term operating margins, they expect this to be between 15 to 25%. Actually, management tells us that they expect EBITDA margins to be between 20 to 30%. So if you take a look at their full year projections for 2024, EBITDA to be at around 140 to 155 million, which is within the 10 to 11% range, which means that if you consider their adjusted EBITDA, they still can possibly double or even triple this number in time to come. However, there are also basically 3 risk factors that I want to consider moving into this investment. The first one is that this is still a drug manufacturing company. After all, compounded or not, there are bound to be complications along the way. And then sometimes you see report like this, right, where adverse side effects of drugs will definitely affect public perception. No matter what you say, even though it's unfair, even though you do everything right, as long as there's some sort of adverse side effect, right, public's perception will always be it's your fault as a drug company. So there's no way for me to foresee this or objectively include it into my projections, which is why basically in terms of a portfolio sizing, this would definitely be a much smaller position. So you see, for companies like SoFi, I can project out a recessionary scenario. I can hang my hat on certain tangible metrics that I can use to project out a recession, right? Like for example, in a recession, I'll need lend to high FICO score above 744, things like that. So maybe my lending revenue will go down by a certain amount. So these are things that I can project out into the future. However, when it comes to things like, adverse side effects of drugs, there's no way for me to know whether or not which batch of medicine will have adverse side effects and how it will affect the company. So on the business side of things, I think the opaque subscriber numbers, which doesn't show me the marketing efficiency and the stickiness of the product, make it such that I cannot accurately assess how good the product is and how fast the moat is growing. Because like I said, if I feel like the biggest selling point or the biggest moat of this company is their personalized subscriber business, then this is something that I want to track even more deeply. And finally is the way the company actually manages and navigates through the GLP-1 saga, whether or not there are going to be any legal ramifications, whether or not they can actually sell their products and things like that. There could be possible revenue headwinds depending on how everything play out. So like I said, if you're talking purely from a fundamental point of view, just the numbers, right, this company is a great company. Revenue is growing fast, margins are trending in the right direction, subscription is out, and free cash flow is increasing, and they're also buying back shares. So the numbers are strong, and in that aspect, the fundamental analysis is good. I do think that the risk to reward here is decent based on these numbers. And so another aspect of fundamental analysis is basically the qualitative considerations. So not just having good numbers, but how you get to these good numbers and how you plan on sustaining these good numbers. So this aspect of the business, I believe the risk factors to me will only resolve itself over time. Does it justify the 40% decline in stock price so far? I would say probably not. But I think when you're looking at a new company, it's always good to give yourself a bigger than normal, larger margin of safety. I started a small position here, about 1% of my portfolio only, so that I'll keep up to date with the company. However, for me to want to build this out into a full position, more than a swing trade, then I'm going to have to see much more execution from the company. The price just broke down past the 200-day moving average. So for those who don't have a position, I won't be in a hurry to start a position here. I'll wait for it to actually find some sort of technical support while I continue to study this company. But if you want something less risky, there's always another company that could be undervalued, and I speak more about it in this video over here, and I'll see you in the next one.